Should you pay off your mortgage as quickly as possible, or should you invest that money instead? Here's what the math shows, and here's what most people actually get wrong. If you have a mortgage and extra cash lying around, it's likely you Googled this question and got 5 different answers, each saying why they're correct. Here's something that nobody says. There is a version of you where it does not make sense to pay down the mortgage. Every dollar should be invested instead. And there's also a version of you where paying down that mortgage may be the smartest financial move you ever do. And the right answer depends on the type of person you are, and by the end of this video, you'll know exactly what to do next. Get this wrong, and depending on your investment rate of return, this could lead to $30,000 to $150,000 difference for a single mortgage. So here's exactly what's coming. Number 1, the actual break-even math and what rate of return and mortgage rates leads to similar outcomes between both situations. Number 2, the one number that nobody thinks about or adjusts for, and how this could completely change the way that you think about your mortgage. And number 3, the honest answer once you stop pretending that you're a spreadsheet and you're actually a human being that behaves differently under pressure. So to answer this question, we're going to go through an example. Let's say that you have a $100,000 mortgage, but you also have $100,000 saved as well. The mortgage rate is 4% and it's amortized over 25 years. That leads to a mortgage payment of $527.84 every single month. If you make that mortgage payment on schedule and nothing else, you're going to make about $158,000 in payments, of which about $58,000 of that is actually in interest alone. Just a quick note, most people don't know what that mortgage payment is going towards. Actually, at the beginning of a mortgage, most of that mortgage payment is going solely towards interest. Barely anything is actually reducing your loan. But by year 20, that flips on its head. Almost all of that mortgage payment is going to reducing your loan, and very little is going towards interest. And that's just how a mortgage works. Front-loaded interest and back-loaded payoff. And this is important because an extra dollar of prepayment to your mortgage in year 1 means a lot more than an extra dollar prepayment in year 20. But the big number is $58,351. That is it. That is the maximum amount of interest you can save by paying down your mortgage immediately. If you were to take your $100,000 and use it to pay down your mortgage on day 1, you would save $58,351 in interest, nothing more than that. Prepaying your mortgage is basically like taking your money and putting it into a savings account that pays you 4% after tax every single year. Nothing more and nothing less. And once that mortgage is paid off, your savings account is closed and you don't save any more money. So let's say you invest the $527.84 in mortgage payments that you don't need to make now into the market, something like the S&P 500 every single month. And let's compare that to someone who decides to take that $100,000, invest it into the market immediately, and just make regular mortgage payments on the mortgage instead. I ran this scenario at 5 different scenarios, each assuming a different rate of return from your investments. Let's assume your investment return is 3%, which is lower than your mortgage rate. This is an extremely unlikely scenario, but if this does pan out, then taking your money and paying down your mortgage immediately and investing the difference is going to come out ahead by about $24,000. If your rate of return is 5%, then actually investing the $100,000 comes out ahead by about $34,000. If the rate of return is 6%, then investing comes out ahead by $61,000. At 7%, it's $145,000. Keep in mind, we didn't look at any tax implications because everyone's scenario is going to be different. So the break-even point here is 4%. Basically, that's because that's what your mortgage costs and that's what your investment rate of return is. So if that's the whole story, this is a pretty short video. If your investment rate of return will be above 4%, then invest the money. If it's below 4%, then pay down your mortgage. Except that's not the only number you should be comparing against. Stick with me. If you invest in diversified index funds, it's quite prudent to expect a rate of return anywhere from 8 to 10% over the next 25 years. Historically, that's what the S&P 500 has provided. Even if you were to be conservative and use a 6% rate of return, that still puts the math ahead by investing the $100,000. The size of the gap between your rate of return and your mortgage rate matters a lot, and this can help visualize it. See how closely these two lines start out when we're comparing between investing the $100,000 or using it to pay down your mortgage. And near the end, they start getting further and further apart. That's the entire story of compounding in one picture. It's small, almost invisible at first, but then your rate of return compounds on a larger balance. So here's the question a spreadsheet can't answer. Everything so far assumes that you're actually doing it. Investing your mortgage payment through market crashes, when the market recovers, when there's news articles saying that the market is overvalued. You consistently have to do it over time because the reality is you cannot time the market. Here's the uncomfortable data, and it's based on actual research, not our $100,000 example. Over the last 20 years, if you were to have $100,000, put it in the market, set it and forget it through all the thick and thins of the market, you would end up at $717,000. But the average investor over the same 20 years, when you bring in human emotions into this, actually ended up with $345,000 in the exact same market, exact same timeline, exact same risk. That's less than half because humans try and time the market. They try and sell at the right time, and they try and time when the right time to get back in is. So they have to be right twice. And that massive gap isn't a market problem, it's a human behavior problem. It shows up again in the data year over year in good markets and bad markets. And here's why this matters way more for this specific decision versus a regular investing decision. Think about what we're asking someone to do. Invest the difference. You are not making one lump sum investment decision. You are going to be making 300 decisions every single month for the 25 years throughout the 2008 recession, throughout the 2020 pandemic, throughout 2022 rate hikes. A lump sum decision, invest it once, set it and forget it, is a single decision. And then you leave that money in there, don't touch it, forget about it. But if you pay down your mortgage and want to use the mortgage payment to invest, you're going to have to talk yourself into doing it every single month during the best of times and during the worst of times. That's not a math problem sitting on a spreadsheet. That is real world implication of doing something like this. So you can be right about the math and still wrong if you don't execute for 25 years straight. But on the flip side, here's what the math doesn't price in scenarios where you lose your job. A paid off mortgage means that your monthly obligation drops, and so there is very minimal housing risk. For a lot of people, that certainty in knowing that they're reducing the debt and reducing the risk could be worth more than 80 or 145K sitting in an investment account. And that's not irrational, that's just optimizing for peace of mind versus investment returns. And if you have a smaller mortgage or no debt at all, maybe you can make more rational, level-headed decisions coming from a place of math versus a place of fear. So we've been covering the psychological part, the pros and cons of each approach. Ultimately, it comes down to the person. If you're a pure math maximizer, rationally, you look at quantitative data, you have no emotions in your decision-making, volatility isn't going to scare you, then generally, for the majority of these people, taking that money and investing it instead of paying down your mortgage is going to lead to a greater rate of return over the long term. And honestly, it's not even close. If you're ultra conservative and debt keeps you awake at night, or you're afraid of your income or your employment, then paying down the debt may be the better option for you. You're not being bad or irrational with money, you are just pricing in risk that is not shown on a spreadsheet. Most people are not going to be in either camp. The reality is that most people will do a combination of both. You'll reduce risk by using some of that $100,000 to pay off your mortgage. You may reduce risk and keep peace of mind by using some of that $100,000 to pay off your mortgage and reduce your mortgage payment. And you may take the remainder of the money and lump sum invest it instead. That reduction in mortgage payment, you can continue to invest that into the markets as well. So the mistake isn't landing in the middle. The mistake is landing in the middle without knowing why you're doing it. So hopefully you found this video helpful. Just remember, real risk doesn't always reflect on a spreadsheet. Subscribe if you want to learn more about mortgages, how to optimize your financials, and feel free to book a free call with me if you want to chat through your personal situation. Until next time, everyone, peace. This content is for general informational purposes only, and it's not financial, tax, or legal advice. While I am a licensed mortgage agent, I'm not your mortgage agent, and nothing here creates a client relationship. Everyone's situation is different, so please qualify and consult a professional before making any decision. If you'd like to talk through your specific scenario, book a call and I'll help connect you with the right professionals.